Capital expenditures play a major role in business growth, yet many owners misunderstand how they work. Some people see them simply as large purchases, while others assume every business expense qualifies as a capital expenditure. In this video, we will explain all about capital expenditure in business finance with practical examples. What is capital expenditure? Capital expenditure refers to money spent by a business to purchase, upgrade, improve, or maintain long-term assets that are expected to provide benefits for more than 1 year. Instead of supporting daily operations, capital expenditures are designed to help the business grow, become more efficient, or increase its capacity over time. For example, if a manufacturing company buys a new machine that will be used for 10 years, that purchase is considered a capital expenditure. If a retail store renovates its location to improve customer experience, that renovation may also qualify as a capital expenditure. Purchasing company vehicles, constructing a warehouse, or investing in advanced technology systems are additional examples. Businesses make capital expenditures because they expect these investments to generate future returns. A new machine may increase production speed. A larger facility may allow the company to serve more customers. Improved technology may reduce labor costs and improve accuracy. Capital expenditures are often associated with growth, expansion, and modernization. They usually involve larger amounts of money compared to regular business expenses. Since these assets provide value over multiple years, businesses carefully evaluate whether the investment will contribute positively to future performance. Capital expenditure versus operating expense. One of the most important concepts in business finance is understanding the difference between capital expenditures and operating expenses. Capital expenditures involve investments in assets that provide long-term benefits. These assets are expected to contribute to the business for several years. Examples include buildings, machinery, computers, vehicles, and major renovations. Operating expenses, on the other hand, represent the everyday costs required to keep the business running. These expenses occur regularly and are generally consumed within a short period. Examples include rent, utilities, employee salaries, office supplies, insurance payments, and marketing expenses. Consider a restaurant as an example. Purchasing a new commercial oven that will be used for many years is a capital expenditure. Paying the monthly electricity bill is an operating expense. Buying a delivery vehicle is a capital expenditure. Purchasing cleaning supplies for the week is an operating expense. This distinction matters because businesses account for these expenses differently. Capital expenditures are treated as investments in long-term assets, while operating expenses are generally recorded as costs associated with current business activities. Understanding the difference allows owners to create more accurate budgets, plan future investments, and maintain better control over cash flow. Businesses that fail to separate these categories properly may struggle with financial analysis and decision-making. Types of capital expenditures. Capital expenditures can take many forms depending on the nature of the business. However, most investments fall into several common categories. The first category is property acquisition. Businesses may purchase land, office buildings, factories, warehouses, or retail locations. These investments can support expansion and increase operational capacity. The second category involves machinery and equipment. Manufacturers often invest in production machines, packaging systems, assembly equipment, and specialized tools. Service businesses may invest in professional equipment that improves productivity. The third category includes vehicles and transportation assets. Delivery companies may purchase trucks, logistics firms may expand their fleets, and construction businesses may buy heavy equipment. Technology investments are another important type of capital expenditure. Businesses frequently upgrade computer systems, servers, cybersecurity infrastructure, and software platforms to remain competitive in changing markets. Facility improvements also qualify as capital expenditures in many situations. Renovating office spaces, upgrading lighting systems, improving storage facilities, or redesigning customer areas can enhance efficiency and customer satisfaction. Businesses may invest in expansion projects, such as opening new locations, increasing production capacity, or building additional facilities. These investments are intended to strengthen the business over time. Although they often require significant upfront spending, they can generate benefits for many years through increased revenue, improved efficiency, and lower operating costs. How capital expenditures affect financial statements. Capital expenditures influence several financial statements, making them important for business owners to understand. On the balance sheet, capital expenditures increase the value of long-term assets. When a company purchases a new machine, building, or vehicle, the asset is added to the balance sheet rather than being treated as an immediate expense. Over time, these assets gradually lose value through depreciation. Depreciation spreads the cost of the asset across its useful life. Instead of recognizing the entire purchase amount in 1 year, businesses allocate portions of the cost over multiple years. The income statement reflects depreciation expenses each year. This means that although the company spent cash up front, the expense is recognized gradually rather than immediately. Capital expenditures also affect the cash flow statement. Since these investments involve spending money on long-term assets, they usually appear under investing activities. For example, if a business spends $100,000 on equipment, cash decreases immediately. However, the asset remains on the balance sheet and contributes value to the company over many years. Understanding these financial impacts helps owners avoid confusion when reviewing reports. A business may appear profitable while still experiencing reduced cash balances because of significant capital expenditures. This is why strong businesses monitor both profitability and cash flow when making investment decisions. How businesses evaluate capital investments. Because capital expenditures often require substantial amounts of money, businesses typically analyze investments carefully before committing resources. One common method is calculating expected return on investment. Owners estimate how much additional profit or savings the investment may generate compared to its cost. Another approach is measuring the payback period. This determines how long it will take for the investment to recover the original amount spent. Businesses also consider future demand. Purchasing additional equipment only makes sense if customer demand is expected to support increased production. Cost savings play an important role as well. New technology may reduce labor costs, improve efficiency, decrease waste, or lower maintenance expenses. Risk assessment is equally important. Economic conditions, industry trends, customer preferences, and competitive pressures can all influence whether an investment delivers the expected benefits. For example, buying expensive machinery may seem attractive, but if demand declines significantly, the business may struggle to justify the investment. Successful companies combine financial analysis with strategic planning. They ask important questions before spending money. Will this investment increase revenue? Will it improve efficiency? Will it support future growth? Will the benefits outweigh the risks? Careful evaluation helps businesses avoid costly mistakes and allocate resources more effectively. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.